faith. Have faith. Believe in your source. Have faith. Have faith. Have faith. Believe in your source. Have faith.
Here's what I'm trying to talk to you guys about is you cannot let the dust settle on your feet right now. You're going to have to be reacting very, very quickly to these markets because there's no guarantee that we have now entered an Armageddon recession, and there's no guarantee that we're going back to all-time highs. The only guarantee that I've got for you guys is that you're going to have to move quick because the markets are going to remain absolutely volatile. Guys, we went up to 560 on the SPY and we got rejected, and we came down nearly 10%, which was a fast and hard move that occurred in 3 short weeks. Then we went all the way back up to 560 and we've gotten rejected again. Everybody knows that that's a bearish double top, and we have now moved underneath the 50-day SMA, simple moving average. And if you don't know what that means, it means that the Wall Street, the S&P 500 is not on offense. It's not on defense. It's on straight decline right now. And what caused this decline? Well, we got the jobs report, and we've been talking about it before we even got into September, but that by the time we got August's job numbers, that depending on if they were pretty bad, the market was really priced it to perfection, priced in a lofty way. NVIDIA told us early on that these markets were not going to continue to climb. It set the pace for every day after that. We've been on decline. Now we're beneath the 50 SMA, but we're sitting on support. So we moved very quickly down to a significant level of support. In a few minutes, I'm going to take you guys into the SPY chart and tell you that if we don't pop on Monday higher, the level of support beneath us right now is significantly lower. And so this, you might be asking, can this get worse, Josh? Absolutely. Don't get tangled up in the ropes. If you are in some long positions, you might have to hop out of them. And if you're in some short positions, and on Monday, I show you that we do get above that line in the sand, because I'm going to show you exactly what that number is going to be. If we get above it, then you're going to have to be jumping into those long positions. You're going to have to be quick. You can't let that dust settle on you right now. Don't get caught up being a bull or a bear right now. Follow the markets. So what did the markets like or dislike about that jobs report? Well, I'm going to break down the 3 big factors of that unemployment report. It basically covered non-farm payrolls. And you might ask, well, what is that? You know, I don't know why they throw the term farm in there. It's simply meant to describe every job that gets added except for farming. And so the non-farm payroll report is about people getting jobs in August. How many people got jobs in August, and what type of wages did they get? So it's going to be a breakdown of how many people got a job, and did the average wage go up or go down? I've got some very interesting data that you are not going to hear in mainstream media, because it's going to be a story within the story. We're looking at how the market's reacting to this employment report. But beyond that, I think you need to hear the raw data that's come out here in the last 30 days, because it could affect you both financially in the market as well as your life, your ability to get a job, or keep your job, or for your kids to get jobs in the days ahead, because this report came out with some very interesting details, and I'm going to break those down for you guys here in just a minute. We're going to talk about crypto, because Bitcoin did what I predicted, that it would come down to 54K. It did it. It came down a little bit below that, and it's since come up. And I'm going to give you guys the line in the sand there. I promise you that when I'm done, I think you'll have a clear perspective of what we need to see happen tomorrow to get bullish on crypto again, or whether or not it doesn't happen. And I'm going to tell you guys what the worst of the worst downturn could look like. And I'm going to tell you there as well that if you're doing a buy and hold strategy on Wall Street or cryptocurrency, and you're unwilling to make a move out of that position, you're just going to end up holding some bags if we don't hit the numbers we've got to hit. I want to remind you guys, I am a trend line structure trader. I'm watching the charts, and it's all about how price action breaks through and confirms either beneath or above those important trend lines. I promise you to show you those lines in the sand. This is the Stocks with Josh show. I appreciate you joining me. Thank you for hitting the like. It feeds the video out to more viewers. If you need help trading the choppy markets, then hit the like and subscribe and the all notification bell to get the next video. And over in the Stocks with Josh Discord, I'm going to be doing my teaching video this week. Every week I drop a class. I'm going to be doing my teaching video about the fundamentals of the 3K to 10K challenge. Now, I know that everybody hears that we're going to do a $3,000 to $10,000 challenge. And the only thing that most people hear is I can take my money and I can get more of it. That is important because everything I'm doing is about making some money and helping you make some money. That has to be the bottom foundation. But more importantly, it's going to be me sharing how to control position size, how to manage stop losses, how to trade the trend, and how not to overtrade. Those are my 4 disciplines, and that's the reason I'm doing this challenge. Not just to help you guys make more money, it's to show you how to have discipline in growing a small account and emerging from somebody with a little bit of money who eventually can one day have a nice little bag. And after we go through that jobs data report, you're going to see how important it is right now to have a financial plan and to be independent of basically get emancipated from your employer. That situation where you trading your time for money, you can't win that way. And in the end, with everything the politicians are doing, you have no idea whether Social Security is going to be there or whether your pension's going to be there. And you say, well, Josh, why are you freaking me out about my pension? Well, because your pension's controlled by these large investment companies who are often buying American debt because it's safe, the bonds. But if the American dollar explodes, the bonds are the ones that are going to get hit the most. Now, I'm not saying that to freak you out. I'm just saying that it's time to get educated on Wall Street so that you can be prepared and not scared. All right, let's kick things off with the 3 things that we're going to cover regarding the jobs data report that did crash the markets on Friday. It got pretty darn ugly. We're going to cover non-farm payrolls. We're going to cover hourly wages, and we're going to cover the unemployment rate, which is all very interesting. And then I'm going to give you an overview of how the market reacted to that data. So basically, the non-farm payrolls represent new jobs added that they went up. So it went up. There was more jobs than we had the previous month, but it did not meet analysts' expectations. Well, I'll tell you, here's the big problem that the analysts have with the miss of expectations is that those creating this report, the government, is constantly revising to the downside the data they're giving us. And so 6 out of the 7 last reports they gave, the data was not correct. So it was wrong data. And then they had to come back later and say, actually, we didn't create that many jobs. We created less than we thought. Now you say, okay, well, how many jobs did they get it off? Maybe only got it off 2-3%. No, they overestimated almost 1 million jobs that they didn't get created. So they were over by 800,000 jobs that they were telling us were created, telling us the economy was doing well, when in truth, those jobs were never created. It was an absolute untruthful situation. So the fact is, they didn't even hit the number that the market expected, and the market doesn't trust the number they gave. And so it's a big problem. But here's another interesting thing. This is one of the things I think that a lot of people need to be aware of. What type of jobs got created? Okay. Well, first we have to understand what types of jobs got lost in the month of August. Nearly 500,000 full-time positions were lost in the month of August. And then on the heels of that, 527 part-time jobs got created. Well, right away, you could imagine what might have happened in August. Someone got laid off of their full-time job, turned around, and had to get 2 part-time jobs to make ends meet. And there is the shift of jobs that got created, is people getting more part-time jobs to cover for having lost their full-time job. Now, that's just a speculation, but trust me, we want to see full-time jobs got added, not seasonal or part-time jobs. And then who's getting these jobs in August? Who got the jobs? Well, we have that data. And that data is the part that's not going to be reported in mainstream media. And no, I'm not getting political. I'm just telling you that if you didn't hear this, there's a reason why they didn't want you to know it. And that's that those who were born in the United States, okay? So people that were born in the United States, 1.3 million people born in the United States lost their job in the month of August. Now, the people that got those jobs that were gotten were people that were born outside of the country. So foreign-born individuals made up 635,000 hires in the month of August, while native-born Americans to the tune of 1.3 million lost their job. Now, that's very concerning. And I've been talking to you guys about the fact that I don't think that the immigration that we're seeing in the United States is properly being accounted for in the unemployment numbers. But here we've got a little piece of what's happening. And there's a number of reasons why this should be a concern, because native-born Americans actually pay more taxes, okay, and receive less benefits. And so I'm not going to get into all of that. I'm just letting you know that this is not in itself a positive shift, because it means that we're going to have less employment overall and less taxes coming in this scenario. Okay. Now we've got hourly wages. So this was actually one of the small bits of light in the unemployment report, is that hourly wages actually went up 0.4% month over month. And so now I can tell you right now that even though Wall Street did not like the jobs report, we would be even in more trouble if we had higher unemployment and decreasing wages. That would be even a greater concern. But one of the bullish factors of this jobs data report, and one of the reasons why we may not continue to crash from here or could rally once the Fed gives us the first cut, is that wages are still going up. We'll have to see if that gets changed in the revisions, but it's still positive. Now, here's an interesting statistic that I thought you guys might like. The average hourly wage in the United States is $35. That is the average hourly wage. And so you want to take a minute and consider, are you getting your fair share right now? The unemployment rate went down. So unemployment actually decreased in the month of August, and that was in line with expectations. Overall, the market interpreted it two different ways. They sold stocks. They sold into the data. I think largely a big portion of that is rotation and profit taking because of where we're at in the year. But I don't believe, and this is where I think this is the final observation, the expectation of a 50 basis point rate cut actually dropped after the report. So the market sold off, right? But the expectation of a higher rate cut decreased. So what am I saying? Everybody was thinking we might need a 50-point basis rate cut, but after the report, that number came down back to 25, which means that they're imagining that the Fed might be okay. That out of that report, even though they used it as an opportunity to take profit, they actually saw some strength in the economy, or not as much weakness as concerned them. That's what we got from the unemployment report. Okay, let's transition. I want to remind you guys that we're still in an election year. It matters. We have past history. Believe the charts. There is the idea that once we get through whatever we're going to experience here in September and maybe a piece of October, that we're going to actually continue to fly back up till the end of this year. Is this the beginning of the Armageddon? Absolutely not, from my opinion. Are we in a moment of incredible volatility? Absolutely yes. Just like those who are hopping at the beginning, you're going to have to react to these markets. Now, if you just want to sit it out, accumulate some cash, not do anything with your portfolio, then I'm going to tell you the opportunity is getting closer and closer to be buying this dip for a run up into the end of this year. Largely, I told you guys more than once in the last 30 days that I think the year is going to end up largely flat. I am not at this moment imagining a massive correction this year. I think things are going to go according to plan, and I think that we're probably going to have a deeper pullback at the beginning of 2025. Do I know that for a fact? No, I do not. We're going to take it one day at a time, and we're going to follow the charts. And then I'm going to ask you guys this, okay, as far as this whole idea of where the direction of the market's going to go. What's the catalyst exactly? I want you to tell me in the comment section, why do the markets have to crash right now? I've given you the case for why we will have a recession. A recession is a 20% decline. And just like in the COVID scenario, the market could do that in 30 days. It doesn't have to be dragged out for 365 days. I have a personal feeling that based on the level of volatility that we're seeing, I think it's far more likely that when the market decides it's crash time, I believe that we will get down that 20% in a much shorter amount of time than people are expecting. And then I think we're going to see a recovery much quicker than anybody's expecting. You don't want to be in a situation where when we pull back 20%, you're afraid to invest. That's a perfect segue to Bitcoin, because Bitcoin did what I said it would do. It came all the way back down to 54,000. And I want you to know that my initial instinct was to buy, and then I got a little afraid when we dipped beneath 54, and I had to do a lot of internal thinking, and ultimately I put some money to work. I rallied some of those who are closest to me, and I said, guys, let's stick to the trade plan. Now, I don't trade for anybody, but I do have a community, and you guys know who some of those people in the community are, and I did encourage buying right at that 54K level. I'll take you into the Bitcoin chart here. We'll go Bitcoin, SPY, and one big tech company that you need to be watching. Lines in the sand on all three. But let me just make this point. For me, this dip was an opportunity to buy. And yes, I was scared. And that's how I knew that it was time to buy. Because when I think of neglecting my well-cultivated trade plans, which are definitely big picture view scenarios, and when I'm afraid to move, the minute I feel that feeling, I go, they're trying to get me again. I'm not going to fall for it. I'm buying. Well, that's what I'm doing. I'm not telling you guys what you should do. There's no guarantees. I'll show you the line in the sand on Bitcoin that if we do cross below where we will go, and that would be a world of pain for all of us, but I'm not convinced we're going to get there just yet. Let me start off by taking you into the Bitcoin chart, and we'll just go from there quickly through the last three charts. I will timestamp this video for everybody. Okay, I cannot make this more simple. We're going to go through it very quickly. The white line is the 50 SMA, and again, we've come back and touched it. The last time we came back and broke through it temporarily, before that week had ended, we got a massive wick and price moved all the way back above this important level of 56,464. Now, tomorrow, this weekly candle closes. You're looking at weekly candles. And yes, tomorrow at midnight, before we get there, this thing could go green just like it did the last time. So be aware that we could get this candle to go green. Now, Monday morning, we could also stay above the 50 SMA on the weekly time frame, and we could go green. Here's the main thing I want you guys to be aware of. 56,464 is your new line in the sand. If by this Sunday or next Sunday we're still beneath 56,464, then you could expect a very strong, rapid move down to support, which I've identified as 47,000. That would be where we could wick to. Now, if we can, either Sunday night or next week, close above 56,464, then the target, I got the smiley face with hard eyes, the target pushes us all the way back up to 70,000. So that's your Bitcoin chart. Let's quickly look at the RSI. I want you guys to see this right now. You can see that we've got this RSI momentum resistance line that we've yet to break back above. So I'm going to be watching for this break back above that yellow line. That would signal a much longer bullish move. Okay, we're going to take a quick peek at the SPY. I talked about it a little bit right at the open, that we're dealing with a bearish double top. Bearish double tops get confirmed when the price closes below the lowest level of the middle, which is right around this 527. So if we close price beneath 527, then it means that we're going to at least move down much lower. We would at least move down to this 493. At the moment, we are again beneath the 50 SMA, which means that we are not in defense. We're in full-scale decline, but we ended the week on this level of support at 540.80. And so here's the main thing I want you guys to be aware of. If by Tuesday we are above this 540.80, then I believe that we could see another V-shaped move on the SPY. If by Tuesday we are beneath this 540.80, then we have to have the target on the table of a move back to 527. Now I'm going to take you into this big tech stock, which was the absolute worst performer on Friday. The percentage down was disgusting. And if you are a Tesla holder, you've got to be pretty upset right now. And I have been not talking about Tesla for the last couple weeks, focusing more on NVIDIA because largely Tesla was doing what I expected it to do. Now, the question that we're going to answer once I get through the chart is Tesla turned bearish again, or are we still in the bullish trend overall? Before we even get, well, I will save it. Let's get into the chart, and then I'm going to give you my opinion on the Tesla chart and exactly how I'm trading it next week. Let's go check that out. You guys can see that we have this extremely ugly red high price move engulfing bearish candle. It engulfed the last 2 days. Now, technically and interestingly, we've simply come back and tested structure. We tested this breakout zone that we got on Tesla. So it makes the next couple days super important. Now, I could see us having essentially a bear trap if this were to break beneath this important level right here, which is really at the moment right around 208, it could come back as low as 204.60. And if it bounced there and moved back into this channel, then I think the bullish narrative continues. We've simply back-tested our breakout zone, and that's really not that bad. And I'm going to keep it simple because the 204.60 is the line in the sand. If by Tuesday or Wednesday we have candles that have opened and closed beneath 204.60, then it means that we could easily come back to the $200 to $183 price range. At the moment, I'm leaning towards believing that this is going to go bullish, that we're going to get a fake out here at the bottom of our ascending channel, that we might test this support level of 204.60, bounce, come back into the channel, and continue to move higher. Overall, you might ask, why? Why are you still bullish on Tesla, Josh? Because Tesla is both rate sensitive and news driven, and we've got opportunity in both of those areas, catalysts for Tesla to move higher, both in September and October, okay? And I'm going to say it again because I was right before, and I might be right again. Tesla can move $100 in 30 days. Tesla can get back to $300 easily in just a couple weeks. And so the question that I have to ask myself looking at that chart, it's largely still bullish. Anything above that 204, we're still in the hands of the bulls. And so that's the line in the sand. But now I've got catalysts, which could move me higher. And so we're going to be watching those catalysts. We're going to be watching the chart. But just like those who are moving quickly with the jump rope, you better respond quickly to this market. Otherwise, you're going to get tangled in the market's ropes. Guys, I'm going to leave it right there. Appreciate you joining me. I needed to put an extra video in this week because I hadn't made too many videos while I was traveling. But I am excited about this upcoming week, and I'm excited about making some money. So make sure that you come over to the Stocks with Josh Discord and check out what we're doing this week. I think it's going to be a very good trading opportunity week, and I'm hoping to make a ton of money. So come check it out. Appreciate each and every one of you guys. Thank you for the like. Hit that subscribe. Peace and blessings. We'll talk to you soon. Enjoy your weekend. Bye-bye.